The Frank G. Zarb School of Business and WRHU-FM Radio Hofstra University invite you inside the Z-Suite.
Hello, I'm Janet Lenihan, Dean of the Frank G. Zarb School of Business at Hofstra University. Welcome to Inside the Z-Suite, featuring current topics and talks with business leaders across every industry. In this episode, we'll explore the complex dynamics of U.S. public equities and investing, including passive investing and its impact on market efficiency and small-cap companies. We'll also address the challenges and opportunities that financial managers face in today's investment landscape. Joining us for this episode is finance and investment expert Richard Gray, Chief Client Officer at Engaged Capital, a constructive activist fund where he is responsible for managing client relationships and new business development for the firm. Prior to joining Engaged Capital, Rich served 2 years as Managing Director with J.P. Morgan Asset Management and was responsible for new business development in their global alternative investments business. He also spent 8 years with the alternative investment firm Remius, LLC, as a Managing Director, covering new business and product development, where he also served as a senior team member and led business development efforts for Starboard Value. His previous roles include senior management positions with institutional asset managers, John A. Levin & Company, Goldman Sachs, United Asset Management, and Dreyfus Corporation. A proud Hofstra University alumnus, Rich graduated with a BBA in Investments, Banking, and Finance from the Zarb School of Business. Rich, welcome inside the Z-Suite.
Oh, it's good to be here, Janet, and hearing you talk about my bio, I realize how old I am.
Well, we're hoping with that comes wisdom.
Let's hope.
And that's why you're here today.
Yeah.
So let's start by exploring your career trajectory, which truthfully is really fascinating because you've held so many senior roles across many, many different organizations within the investment industry. So can you share how each of these has prepared you and shaped your approach to your current role? And really maybe tell us what interests you in getting involved in business development in the financial industry.
Sure. So I was always a curious kid. My first books I read were Curious George books. And then I graduated to Atlas Shrugged, which literally just changed my life when I read Ayn Rand, and said I want to be involved in finance or industry in some way. Took a business class in high school. I had a great teacher. She came from a very successful Wall Street family and had said one of the keys for a young person is to network, meet as many people as you can, learn about every aspect of the business, see what you have an affinity for, what you don't, and said your age, the things you find not exciting are probably as valuable as the things you might have a passion for. And so my uncle had a firm on Wall Street, did bond trading, which sounded sexy and fun. And the more I learned about it, I was like, no way. Talking through a phone for 8 hours a day, not meeting people, not for me. And then got through another family connection, introduced to an investment consulting firm, which is still around today. Through that, I got to see, at that time, every conceivable type of money management firm come through our doors, pitching their services, hoping that we would introduce them to the mega large pools of capital that we represented, public pension funds, corporate defined benefit funds, endowments, foundations. And I just found it fascinating. I just thought there's so many different types of pools of money out there, all with different objectives and goals. And there's many ways you can go about solving for the problem of how do I keep growing my pot of money. Just decided that, hey, I got to get on the money management side of the business. And so I landed at Dreyfus. And that was interesting. I got to get exposed to how people manage money, but found the institutional side of the business a lot more interesting than the retail side. And then from there, I went to an investment banking boutique that was publicly traded, where we acquired money management firms around the globe. So I got to see how really well-run investment management firms conducted themselves. And then we wound up selling that business. From there, I was invited to interview at Goldman Sachs. And they were really just starting to take investment management seriously, really for the first time. Had about $100 billion in assets at that time. 6 years later, $600 billion. So they really took it seriously, but got to be involved with teams there that built a great business. And we really built out the alternatives platform there in addition to the traditional asset management businesses. And I just found that to be the future. And I was always a big believer in the Gretzky quote, don't go where the puck is, go where the puck's going to be. And so that's always kind of geared my thinking about where I want to go next. And I've been very fortunate. I've always been recruited to my jobs. I've never had to find a job other than my first one. And I think that goes back to the networking, right? I do a lot of networking with folks. And I love the aspect of investing money, but I love people. And so in my role, I get the best of both worlds because you got to be smart enough and know enough about the product to be able to have those conversations with clients. But at the same time, somebody else is dealing with that, and I can spend my time, building relationships with clients. So that's sort of how I evolved and got into the role I'm in today.
So really fascinating. You said a couple of terms that I'm not sure everyone necessarily understands.
Sure.
So just real quickly, what is the difference between an institutional and an individual investor?
So retail would be individuals that, maybe hire an investment advisor or broker to manage their money. So this is the retail pool of money. The institutional pool of money would be like the Hofstra endowment, a sovereign wealth fund, a state public pension fund, a corporate defined benefit fund. So there's way more institutional size is the way to think about it. These are typically multi-billion-dollar pools of capital.
Great. And then you also use the term alternative investments.
Yes.
What do you mean by that?
So alternative to traditional. So traditionals are stocks and bonds traded in the public markets. Alternatives are alternatives to the public markets, for starters. So things like private equity, private real estate, real assets, infrastructure. And then there's also alternative approaches to investing in the public markets, both equity and credit as well. Those are typically referred to as hedge funds.
So across your career, you clearly have experienced all different types of markets, from bear markets, financial crisis, bubbles bursting, bull markets. In what ways has your perspective and approach to the industry changed as a result of all of the different experiences that you've had? And specifically, how has it affected how you approach your clients?
Well, I think if you go back, again, I feel so old having this conversation. When you go back to the late 80s and 90s, you basically were assisting these institutions and a lot of the retail, certainly the retail public for the majority of them, you're educating them about what this is. And you were selling them stuff. This is why you need equities. This is why you need bonds. This is why you need 60 of that and 40 of that. And they basically, if you had good performance, would basically engage you or hire you. It was a pretty simple approach to investing. But what happened is the buyers, which I like to call as the allocators of capital, they got sophisticated over the last 40 years. In fact, incredibly sophisticated. And so you don't sell to them anymore. Your best bet is to partner with them and understand what they're trying to achieve as an organization financially, and then bring your network, which again, always going to come back to that network, bring your network to bear to help them get the best solutions to help them achieve their goals. Now, a couple of interesting thoughts on that. One would be, you might say, well, you just do activist investing. What if they need something in infrastructure? Well, I happen to, as I network, know some of the best infrastructure firms in the world, and I could say to them, have you spoken to X, Y, and Z? If not, would it be helpful to get an introduction? Or if I'm talking to the Hofstra endowment, let's say, which I haven't, but let's say I was, and they said, hey, we're thinking about doing private credit. We haven't done that before. I can say, well, here's 3 endowments in the New York area who went through that exercise a couple of years ago, maybe hearing about their experience and how they presented it to their committees and how they got it into the portfolio could be helpful. Would that be helpful? Making those introductions to people as well. So, and I haven't even talked about what we do, right? So it's just providing that network to people to make them smarter, to make them better. And then when you do have an opportunity where there's something that they need that you do, you're probably going to get an at-bat. But even then, I will typically say, have you talked to my peers? And I'll point out a couple that I think are really world-class as well. Worst case, maybe they split the mandate 3 ways. But I always feel that it's the right thing to do to just provide the best advice to clients. And again, they're very sophisticated. You're not going to sell them anything. And I think that's how the market has changed the most over the last 40 years.
But that's how you build trust, right? In
100%,
a relationship.
100%. And by the way, these people tend to move around a little bit. So it's really important to build those relationships because you never know. Maybe they're not going to do activism at this endowment, but maybe they're going to be at a sovereign wealth fund in 5 years, and that's something they want to do. So it pays to build those relationships.
And that's in any industry.
100%.
So you use the term activist fund, and I know your capital is an activist fund.
Yeah.
So what exactly is an activist fund? What does that mean? And how does it differ from passive investing?
The way to think of activist fund is private equity. So if people know what private equity is, it's you take a company that's public-private, you fix the issues, and then you spin it back out as an IPO again, bring it public after you fixed it. We do exactly what private equity does, but instead of taking the company out of the public market, we fix the issues in the public market. And there's a lot of advantages to doing that. First of all, if a company's not willing to be taken private, there's nothing you can do. In the public markets, you don't need a willing seller, right? So we can fix anything we want if we have enough of a stake and can provide good advice to the company. So we're really private equity investors in the public markets. That's what we do. Another way to think about it is because we do have a hedge fund structure, there's things called event-driven hedge funds. And these are people that will think that this company is going to go through a divestiture or do an acquisition or be acquired, and they're betting that that's going to happen. So they'll take a stake in the company. You can think of us as an event-driven fund as well, but we're the event. Traditional management is when, or passive is you're buying an index fund, you get a cap-weighted representation of every name in the index. But I also consider active managers passive, and let me explain that. So let's say you're a long-short equity manager, or you're just a traditional small-cap manager, and you're picking stocks, right? are you really doing anything to influence the outcomes of those companies? Or are you betting or hoping that they go up, right? And there's some wonderful people that do that really well. We're just not smart enough to be them. We have to go fix things. We're not smart enough to see what they say. Those people are really passive in my mind, even though it's active capital. So we don't leave anything to chance. So if we see why a company is underperforming or being mismanaged, and whether that's organizational, structural, financial, strategy, we'll bring the resources to bear with operating partners to bring them into the board to fix the issues of the company. Hopefully the shareholder of the company will see the changes we're driving are creating a lot of increased cash flow and better margins, and then they'll come in behind us, and then the stock price should go up. So it's really the same thing private equity does, just in the public markets. We don't leave anything to chance. We are the catalyst to driving those changes that need to happen in order to reverse the trajectory of the stock.
And I know you have shared with me that a focus of the firm is really on governance, and that's some place where you feel that it has such a huge impact on the performance of the company as well as portfolio returns. So talk a little bit about, you were saying when you see problems, you want to fix them. How does governance play into that?
So, the term ESG became increasingly popular over the last 7-8 years, and there were like a lot of ESG-focused conversations we were having, almost every one. What is your ESG policy, et cetera? And I think the pendulum's swinging back a little bit the other way now, which is fine. But we've never held ourselves out to be an ESG fund. We're an activist fund. We're private equity investors in public markets. That said, the key to anything in a company is leadership, right, and governance, right, having the right leader. If you don't have the right CEO, I can tell you're going to probably have problems. And then you want to upgrade the board, make sure you have a really effective board as well. And having the governance structure that the board is doing their job and making sure we always have the right CEO. And we'll fire the CEO if need be or replace them. And so the first thing we focus on is the G. Why do we do that? I always joke, show me a company with a high E score, a high S score, and a low G score. Good luck finding it. It doesn't exist. You have to get the G right. You get the governance right. And then once you fix the issues, the valuations and the company's at a new high, and there's a new energy and a new, excitement in the company, and the morale's better. And then I think the board should then focus on how can we, any organization, how can we further improve the social? How can we further improve the environmental? I think that's really important stuff. It's not unusual for us to encourage our companies to put out sustainability reports in the public domain saying, here's our targets for the different E and S initiatives we have at the company, hold them somewhat accountable for that. And I think there's not a company on the planet that wouldn't agree that they can be better in those things. But again, I think that's the second conversation. I think the first conversation is you got to get the G right.
You obviously have had huge success in this space. Can you give me one example of what would be a problem that needed to be fixed?
One would be compensation of the management team, and the other would be focusing on the key value drivers of a business. That's typically two things we see in almost every type of investment. So a lot of times when companies start out, they'll tie the compensation of the management team to top-line growth, which makes perfect sense. If we don't grow this thing, it dies, right? And so if you go 10 years down the road and they're very successful and they sort of get their market share and they've kind of saturated the market, that top line is probably going to flatten. People do what they're paid to do. So they might start doing things to grow the top line at all costs, which gets them into capital allocation issues, right? They're not allocating capital properly. They might buy another business that they think is the next growth engine, or they might create one, take all the good free cash flow off the good core business and redeploy that into this future growth initiative that never materializes, and then the street gives up on the stock and capitulates. That's the common thing you'll see. So you got to get them refocused on the key value drivers of a business. And in small cap, with small mid cap, where we traffic, a lot of times once you get a business to that point where they're optimized, a good exit to create more value could be a sale to a strategic, right? Because you might be running well, but you might be subscale. And so maybe a larger company can come in, provide a tremendous premium for shareholders, take a lot of SG&A out of the business, and that's the right thing to do for shareholders. But CEOs like being CEO, and a lot of times that's not a path they're willing to go down. So they say, okay, I've grown this as much as I can. I like being CEO. I don't want to sell the business. Let's try a new growth initiative, which is basically your second best idea.
I want to pivot just to go back to, the notion of active versus passive investing. Over the past decade, we've clearly seen an unprecedented shift towards passive investing. Yeah. It's interesting. There was a recent Wall Street Journal article that talked about at some points during this first quarter of 2025, we actually are seeing individual investors. There was an uptick of individual investors trading in their 401ks, actually at 4 times the normal level, right? Talking about the fear and the uncertainty in the market around tariffs and government cuts and the likes. But yet, even with that uptick, it is such a small percentage. It's not even 0.5% of all account balances across 401ks. And so help us understand, first of all, the broad differences between the two, but also why do you think this has happened, this shift, and what has been its impact on small cap companies?
There's some incredible statistics I'll share with you about passive investing and how it's just going to continue accelerating, what the impact is on small cap and the markets in general. But I think a couple of things are at play here. One is if you look at active management, whether it be somebody that is equities or credit, and you look at benchmarks over time, it's very rare that somebody outperforms the benchmark over a long period of time. So you kind of conclude, why am I spending all these money in fees for that when I can just, for very cheaply and inexpensively, get a passive solution? So I think that was the start of it. And then the opportunity set for a lot of institutional investors was more in the alternative private markets. And so the source of capital for putting money there, which have traditionally been higher returning, was the public markets. So first of all, there's a massive shift in the institutional world coming out of public markets, feeding the private markets. And then when you say, okay, so this is my smaller public book and I'm getting my returns there, why take the risk here? I'll just index it. And that phenomenon really took hold over the last, I'd say, 15 years. And so that's the first thing. Second thing is the 401k machine, as you referenced. So everybody, I think, does 401ks if they have them available to them. There used to be an issue when they first came out in the 80s and 90s of getting people to join a 401k. But I think most people have gotten sophisticated to understand the benefit of it, and most people do it. And so you've got this wall of money every week or 2 weeks when these payrolls do the deductions that come into the 401k plan. And the majority of 401k plan assets are in what they call target date funds, which is really smart. Based on your age, based on your risk tolerance, we'll worry about how to invest it. I think it's just a turnkey, no-brainer, and it's really smart. And as people age, it changes the allocation, protects their capital. I think it's one of the greatest inventions ever. That said, to maximize returns there, most of those underlying managers are passive. You get a low-cost solution that's more money in your pocket over time as it compounds. And so you've got the structural issue of all this capital coming in from the 401k machine on a regular basis, and it's getting hardwired into these predetermined asset allocations. So let's take equities as an example. Russell 3000, that's your top 1,000 companies and your bottom two, which is like basically your Russell 2000, your small cap. If you took $1 billion and you put it into the Russell 3000 today, 300 million or 30% of that billion goes to the 10 largest companies in the Russell 3000. That's incredible.
Incredible.
590-ish, about another 60%, goes to the next 490. So 90% of the billion goes to basically the S&P 500. That remaining 100 million gets split across 2,500 other companies. Let's just focus on the bottom 1,000 of that, right? So the 1,000, bottom half of the small cap market, they get 5 million of the 100 million. Half of 1% goes to those companies. Every 2 weeks or every week when that 401k machine goes, it just exacerbates the problem. More money's going to the larger, less money's going to the smaller. And then you've got institutional investors that say, hey, we like to look at what's driving the market from a risk factor perspective. Momentum has been ruling the day. Growth was ruling the day for a while, and it's momentum, another form of growth. And if you have negative momentum like small cap, less money goes there. If you're positive momentum, more money goes there. And then there's a size factor. Large has done better than small, so more money goes there, less goes to small. So what's happened is the flows have just dissipated into small cap, which has caused more volatility in the names because there's less capital in the names. So when something good or bad happens, the spike in the stock price can go either way. It's pretty dramatic. And so a lot of volatility. And then the other interesting thing is if you go back 12 years and you look at the Russell 2000, back then 30% of the shareholder base across small cap companies was passive, your Vanguard funds, right? Remember I said that trend was starting back then, right? 70% were active shareholders. These were institutional money managers that focused on small cap. These were small cap mutual funds. So 70% were active shareholders that made decisions which stocks to buy. Fast forward today, close to 70% is passive. And that excludes quantitative hedge funds, which is a huge pool of capital that trade on factors, momentum, size, things like that. Again, not necessarily fundamentals of a company. And so you factor that in, there's probably only a quarter of active shareholders in the market than there were 12 years ago. Even if you find a company that you think you can change the trajectory of and make all these changes, you might not have enough active shareholders there to come in and believe that story to actually change the actual trajectory of the stock price. The bottom half of small cap overall is really challenged. I don't see how we reverse that, at least in the near term.
You know, it's fascinating, too, because when you think about the growth of the 401ks because of the decline of the defined benefit plans, right? And so you have people, of course, going towards those targeted funds because that replicates much like a defined benefit
100%.
plan, right? And so why would I ever want to invest in a small cap mutual fund if the volatility is there for my retirement?
That's right. Even when they have like the self-directed option, you talked about it, right? People jumped on that in the last month. How de minimis was it?
It's so small.
Right? It's so small.
Yeah. So small. We've been kind of throwing around the term large cap and small cap, and I realized, you know what, we really didn't kind of define that. So could you define that for us? What do you think are the advantages of investing in small cap versus large cap?
It's really just size, and it's loosely defined. Like I'd say small cap definition was different 10 years ago than it is today, but I would say sort of anything under $1.5 billion is probably $2 billion is considered small cap. Between $1.5 billion, $2 billion, and maybe $8 billion is mid cap, and then over that is large cap, and then you have your mega caps, right? So that's the delineation. And if you look at, like I said before, just the returns that have come from the top 10 names in the S&P, it's beaten the rest of the S&P pretty handedly. So the large are getting larger and the small are getting smaller. So I think it's really hard to say what the advantages are investing in small cap broadly, because I think large cap has just outperformed small cap for so long. And again, hard to see how that necessarily reverts. And people will say like, oh, historically it's always reverted back to small cap. But I think we're in a new paradigm. I really think that those things that cause that, I don't see that happening, at least in the near term. That said, can you make money in small cap? Sure. You have to be more rifle shot as opposed to like an index-based fund or a benchmark-oriented manager. So concentrated managers, I think, are a great way to play that. And if they're concentrated and they have some sort of way of generating idiosyncratic alpha, i.e. they're hands-on like us and go in and make changes to companies, I think that's a great way to make money in small cap. And I think, unfortunately, or fortunately, depending on where you work, or where you sit, or where you invest, I think what's going to happen is small cap is going to become really, in the public market, it's going to be very ripe for private equity. Because if you're not getting the valuation in the public markets,
why should you stay there?
And somebody's going to come and offer you a 30% or 20% premium, it might not be the right number because you know it should be higher in the small cap market, but the tape don't lie. Right? If people aren't willing to come in and move the valuation up, and they're valuing you, they're telling you what you're worth. If you go back to 2000, I think half the number of public companies that were there are here today. Like they've been taken out by private equity. I think that's going to accelerate, but more so in small cap. So small cap rifle shot, find somebody that's got a concentrated approach and maybe some idiosyncratic way of creating alpha at the security level.
Yeah. So you mentioned we're clearly in a new paradigm here in our U.S. public equity market. I know you already shared some factors in terms of how this happened. Talk a little bit about how you see it differing from past markets, but more importantly, moving forward.
Yeah.
What do you say?
I would say, I'll give you a data point on the Russell 2000. So until about, 2 years ago, and for the prior at least 12 years before that, so say before sort of 2023, if you did a performance attribution of the Russell 2000, the whole thing, all small cap, and said, what's driving returns? I think it was like 70% of returns were driven by levered businesses, 4 times levered on average, with no profitability. Think about that, right? That's stunning. That's literally the antithesis of what we invest in, first of all. So it was almost like public venture capital. I mean, that sounds like a venture capital company, right?
Yeah.
And so, that was driving it. All of a sudden, about 2 years ago, I think, people started recognizing like, hey, growth's fine, and growth has outperformed value for a long time, but profitability matters again. And that's a good thing, right? Because those are real businesses. And so I'd say the fact that profitability matters again is really good for our business and good for, I think, fundamental investors. It's not just growth with these unimaginable valuations that are really hard to justify. And you could look at a real business and say, yeah, that makes sense. That's undervalued. This should be the proper valuation, et cetera. So I think the biggest thing is just the refocus on profitability has been really, really important. I think if you go back to what I said before about a company that we can identify, understand exactly what needs to be done, and drive the changes. If you do that in, I think, a little bit larger cap companies, over $2 billion, you'll tend to get more recognition than you will in the smaller end of the market. So again, it doesn't bode well for small cap, but I think that's where, you can still make money. So it still tends to be more focused on larger cap. Profitability matters again. You can go down into the small mid realm and find good opportunities. But below that $2 billion, $1.5 billion threshold, I think it's hard. And again, I don't see anything that necessarily reverses that in the near term. And then, you got the economic backdrop of what we have today. People are obviously concerned about, I don't think they're necessarily concerned about tariffs as much as what will they actually be? Like, you talk to CEOs and they're like, well, which countries is it going to be? Or anything's going to be carved out of there? And so I think until that's settled, there's a little bit of uncertainty around the market. Market likes certainty. They don't like uncertainty. Obviously interest rates have come up as well from where they were. There's no more free money. And so I think investors should be focused on companies that don't have a lot of leverage and a real profitability. I think that's where the opportunity set is.
So do you envision, I know you're saying you don't see in the near term this changing, in more of a long-term view, what happens to the small caps?
I think private equity is going to take a bunch out. I do. I remember when the market crashed in 2007, we thought the biggest distress cycle was going to come where these bad companies that were levered and had no profitability would go into bankruptcy, and the distressed guys would come in and take them out of bankruptcy and make a lot of money. Well, the government decided in March of 2008, this new accounting regulation, FAS 157, is probably not something we should deploy right now because we're still trying to figure out how to get the markets back. And so they shelved that, which basically said to the companies that were levered and didn't have any profitability, you can kick the can down the street. And if you look at how CCC bonds did that year, they rallied 105%. My point is that reckoning never came for those companies. Then rates went to basically zero. So you had free money. So there's a bunch of companies in the small cap world that I don't think really should be there. And so there's been a bunch of acquisitions of those companies over the years. And I think it's Darwinian. The strong ones will survive, but I think a lot of them might not get fair value in the market and will go the way of private equity. And the ones that aren't, I don't know, maybe they just stay small cap and uninvestable. It's just hard to say.
Of course, trying to predict the market is a fool's game, right?
Oh, 100%.
All of this is making me think about what advice could you give to investors to navigate now this new market paradigm. So many of regular individuals, right, are in the market, as you said earlier, absolutely true, in their 401k space. If they wanted to kind of dabble in small or mid-market cap companies, I'm getting the sense you think that's probably not the right way for them to go.
Yeah, probably hire an advisor.
So yeah, that's important to know. So you're kind of a proponent of following the money.
Yeah, and I deal more in the institutional space. And so I can tell you that the institutions, they just keep putting more into the private market. One of the issues they've had with private equity, which is probably one of the biggest allocations in most institutional portfolios for the last 3 years, is they're not getting realizations. They're not getting money back. The companies in these private equity portfolios, the private equity firms don't like the valuations, and so they're not selling them. So you've got this allocation, but you're not getting any money back. That's the whole purpose of the program. And so you would think maybe, right, they'd come back to the public markets a little bit. Enter private credit. So now they see a bunch of money going to private credit, again, out of the public markets, right? More money coming out of the public's funding private strategies, and also real assets as well. They've been putting more money there. So I don't think the allocations will shift all that dramatically. I just think public equity will continue to have its role. It'll be smaller over time. And I think passive is here to stay. That doesn't mean there's not rifle shot ways, again, to find really great money managers. And there'll always be those great, just pure stock. Again, not smart enough to be one of those guys, but they're just great stock pickers. But a lot of them tend to be close to new investors as well. So I think, taking a diversified portfolio approach, hire a financial advisor, probably the best way to go if you're not a person that feels that, they should be making their own decisions.
Yeah. Diversification always, right? Rule number one. Okay, I could keep asking you questions because this is fascinating, but we're getting to that point in our interview where we have a little fun tradition here at Inside the Z-Suite. I'm going to ask you some questions. These are just fun questions that I want you to answer right off the top of your head.
God, this could be scary.
Are you ready?
We can edit this, right?
All right. If you could trade places with anyone or anything, who or what would it be?
I'd love to have a week to think about that, but I don't think that's going to work on this program. I love people. I've always thought people like Larry King and Charlie Rose have really cool jobs. They get to talk to captains of industry and, people in the music world, people in the literature world, people that are, in the movie world business. I think that would be a really cool job.
Excellent. What's your favorite household chore?
I'm a Christmas guy, so decorating the house for Christmas. In fact, my wife and I have a prenup. There's nothing financial. It says I can't put out any Christmas music playlists until after July 4th. And I can't have the decorations in the house till Thanksgiving night. That's my favorite chore.
But the question is, do you take down the Christmas decorations?
Oh, I do it all.
Oh, okay.
Oh, of course. I do it all. Yeah.
Right.
That's my absolute favorite chore.
What's your least favorite household chore?
All the others.
Great answer. All right, final question, and this really is for our students who may be listening. What's the key to success?
Oh, be lucky. But you can create your own luck. I really believe that. But you got to be lucky. I go back to networking. The more people you meet, the more opportunities you'll create. When you meet people, it shouldn't be, how can you help me? It should be two ways. It should be, and how can I help you? And I remember being told that at a young age when I started my career and thinking what the heck could I possibly offer this person? It's the message that you're sending. I'm a person that one day may be able to help you, so I'm going to try. And you stay in touch with people, and all of a sudden as you have more success in business, maybe there's things you can do to help that person and their network. And so I'd say network like crazy. That's the most important thing. I hope and I wish every student of Hofstra that they find something that they love. Because if you love something, it's cliche, but you never work a day in your life.
That is such great advice, both networking and find your passion. 100%. Thank you to Rich Gray for your industry expertise, your wise advice and insights into investing, including strategies and opportunities for companies and individuals. Thanks also to our show's producer, Adrian Stoller, and WRHU audio engineer, John Mullen, for your support. Be sure to tune in each week on the radio and online to WRHU 88.7 FM, Hofstra University, for a new episode of Inside the Z-Suite, or catch up with our show wherever you enjoy your podcasts. For more information about this program and the Zarb School of Business, please visit hofstra.edu/business. Until next time, I'm Janet Lenihan from Inside the Z Suite.